Masterclass with super investors. In this super investor, we're going to learn from Mr. Hiren Ved. Very, very interesting background. His experience in the stock market started when he was a young child, maybe earlier, because his father, his grandfather, everyone was in stock market. So long family history. And so got a leg up very early into this game, and he liked that area too, which is very hard. Like, think about it. If your father, if your grandfather, everyone's into that business, and you get to inherit all the learnings from them, and you get a head start, like he got the referral from his father to work as an intern with Mr. Kisan Choksi. Huge. That's a huge leg up. You've just saved enormous amount of time, and you're starting to invest in yourself, in your growth, and also in the area that you like. So Kisan Choksi actually rotated him in various fields and various departments at his company as an intern. And eventually, Mr. Hiren Ved said, hey, I like this equity research thing. So he made that as a choice, went to various AGMs, not just at the internship time, but also when his father took him at a very young age, and made really good friends. And he realized there were a few other kids coming to those AGMs, and he made them eventually good friends and then eventually partners in his current company, Alchemy Capital. The other pivot or the other breakthrough, I would say, that came in his life was when Rakesh Jhunjhunwala, who actually loved his reading his research because he was doing equity research and publishing those materials. He loved what they were doing, and he was like, hey, why the hell are you guys doing this freelancing work? You should actually set up something as a brokerage, and you should probably start a PMS or something like that. So he actually became a non-operating partner. That was huge, because with him, the non-operating partner, he sent out lots of referrals. The biggest breakthrough came in when the Qatar Investment Authority started investing through them. And the way they did it is pretty interesting. I'd highly recommend you to go through the chapter. But in a sense, what they did is they actually convinced them why they should invest in them by the quality of their work, right? Started small, and then they got more trust and then increased. Eventually, the US pension funds got them to further increase their AUM, and now they deal with ultra HNIs as well. So 3 crore ticket size. He strongly thinks that small companies, for them to cross to become the large companies, there's lots of things have to go right, especially strong mid-management has to be built. They started with 5 crores in 2002. They're 1,000 exit now in 20 years, which is 6,000 crores, more than 6,000 now. And he says, put in a little bit more effort and you will get outsized more returns, because everyone's doing, if you're slightly above the average, over time, you consistently do that, you get much better benefit because the quality of your work shows up. And his insight was that the game of stock market investing today is who is getting the critical information sooner. Like critical in terms of like who's doing well in terms of sales, who's doing well in terms of profitability, who's doing well in terms of strategy, who's good management, how they're executing, like any insight you get about the company sooner. That's the game. He says to look for companies, good companies, look for growth in sales, good governance, absolute value of the place where this company can land in future needs to be really high. Like, for example, he gave a really good example of Bajaj Finance. He says, hey, it can easily reach where HDFC Bank is, and that's like 6x what it is today. So that is huge. So he has this mental map of where the company can eventually go to, and ROCE is what he used. But then he said he missed out on Bharti because of their penetration strategy where they had low ROCE. Investing in companies which have a good admired leader, extraordinary execution, free cash flow generation, low leverage, sales that expect to double in 3 years. He has some of these criteria that I've gleaned through from the chapter, so that's the summary part. He thinks that the tech product company in India, actually, that he's invested, so many of them, have failed for many reasons. He thinks that those products really require deep customer mindset, and product needs to be sophisticated, customizable, but at the same time, you need to make a lot of noise so that you're showing up in your trade shows, lots of marketing, and you need a heavy sales hitter, a guy or a girl who could actually sell hard. So a lot of those ingredients are needed, and so he thinks that the ecosystem for a lot of this is well set up in India, in the US. So he feels that could be a US presence, and then the product also needs to be having a global appeal, because the US companies do build those kind of products. So that was a good learning about his perspective of why he's not made any money, literally any money, in tech product companies. And a few examples he gave was Ramco Systems and a few others. He says, build a habit of reflecting so that you don't make the same mistake again and again. Good. And he has a good regiment he follows, where he certain times he reflects, certain days he reflects, certain time he wakes up, certain times he meets people, certain times he has certain meetings. So good regiment is important. Avoid turnarounds. Lots of things have to go right. There's a reason why they are cheap companies, because there's lots of things have to go right. They have to focus on fewer things. They have to sell certain things. They have to actually figure out sales growth. They have to do a lot of those things for the turnarounds to be successful. Look for US patterns, because they have a very high chance to repeat in India, because they are ahead, and money is fungible. So money moves between borders. So look for patterns, and you can find out. Large companies, again, he said that the small companies really need to build good middle management to scale. So example he gives is this Bajaj Finance, which he bought very early days, and he lists out this really good guy, Nanu Pamnani, who was a really deep process guy. He really made sure that everything worked really well, and that was a key partner that Bajaj Finance had during those times. So he says that for small companies, it's very important to have good management, like 51%, and then 49% could be good business model. But he says large companies, 49% could be like, hey, good management, 51% could be good business model, because it has to grow at that. You have to have the right structures in place for large companies to succeed. Finding out the top guy, his intention, or top girl, his intention, what are they trying to do, what are their habits, what is their processes, what is the fire that they have to bring to the table, what culture, habits. That's how the culture is set, that's how the company is. So finding that out as soon as possible will help. And he says the stock market runs typically ahead of the earnings, so in both directions. So it'll go correct quickly if the earnings are going to tank. It'll go ahead quickly if the earnings are going to go up, right? So I think it's important to know this. I've had some counterfactual evidence for this as well, like Mastech recently, 2020 March. The earnings shot up crazy, but the stock market was down. Maybe it was a macro, because that was a perfect time to buy Mastech, and look where it's at now, 5x in 1 year, right? He does a lot of reading, so he reads lots of newspapers. But the two new things that he shared, which is not referred by other people, is Super Forecasting by Philip Tetlock, and then he reads MIT Tech Review to be updated with the latest in tech. So lots of learnings from Mr. Hiren Ved, and the key insight is top management is critical. Look for patterns. Think about product companies and get critical pieces right. You want to know those critical information sooner, and then build on your strengths. In this case, he had a family strength of being in stock market, and he liked it, so he just built on it. Thanks.